Welcome to the Deep Dive from Talk Tickers. Today we're jumping into the Q3 2025 earnings for a really interesting regional bank. And this wasn't just your standard numbers update, was it? It felt like management was really laying out a longer-term vision.
Oh, absolutely. That's our mission today, really, to unpack that. You've got the strong headline results for the quarter, sure. But underneath, there are these two really significant strategic plays happening. First, what we're calling the defense now, this very deliberate credit portfolio cleanup.
Right, getting the house in order.
Exactly. And second, the offense later, a huge multi-year bet on moving their core banking systems to the cloud. Big stuff.
Okay, let's start with the quarter itself, the immediate picture. Sentiment seemed pretty positive, mainly because the core performance was, well, strong. GAAP EPS was $0.61. But the adjusted number, the one we tend to focus on, $0.63. A solid beat.
And it's worth looking at the quality of that beat, too. Their adjusted pre-tax, pre-provision income, basically profit before taxes and loan loss provisions, hit $830 million. That's up 4% year over year. Nice growth there.
And for shareholders, that translated into a return on tangible common equity, the ROTCE, of 19%. That seems pretty high in this environment.
It's very strong. 19% ROTCE, yeah. It really speaks to how well they're managing things internally, squeezing profit out of the capital they have, especially now.
And you can't get those kinds of returns without a solid foundation. Management kept emphasizing their funding, didn't they? Mentioning top quartile deposit growth while keeping costs low. Lowest among peers, they said.
They did. And that low-cost funding is just crucial. It's the bedrock. It gives them so much flexibility, especially when we get into net interest margin, or NI.
Right, let's go there. Net interest income, NII. Always key for banks. Now, the net I actually declined 6 basis points this quarter compared to last. That kind of headline number might make some folks nervous, you know. What drove that dip?
Yeah, it's a fair question. A 6 basis point drop catches your eye. But it was mostly technical factors, according to management. Some one-off benefits in Q2 that didn't repeat the number of days in the quarter, and also holding maybe slightly higher cash balances, kind of a temporary drag.
Okay, temporary drag. So how do they plan to reverse that? They're projecting a pretty significant bounce back in Q4, right? Into the mid-360s for a name. That's quite a jump.
It is a big jump, but they laid out the drivers. Two main things. First, just basic asset turnover. Older loans and securities with lower yields mature, and they reinvest that money at today's higher rates. Simple but effective boost.
Okay, that makes sense. What's the second driver?
This one's bigger. Maturing CDs. They have a huge chunk, $5.5 billion worth of certificates of deposit rolling off in the fourth quarter.
Wow, $5.5 billion. That's substantial. So what happens then?
They get to reprice that funding. Basically, as those older, maybe higher cost CDs mature, they can offer new ones potentially at lower rates or shift the mix. It directly helps lower their overall funding cost. It's a predictable tailwind, which is why they're confident bumping up the full-year NII growth guidance to 3% to 4%.
And it sounds like they're also pretty well hedged against immediate moves by the Fed. That's a big worry for regionals generally.
Seems like it. They describe their position as relatively neutral, partly good hedging, but also that ability to manage deposit costs we mentioned. They're targeting a deposit beta. How much of a rate hike they pass to depositors in the mid-30s, that's pretty low.
Mid-30s is low. Suggests their deposit base is quite sticky, doesn't it? Less sensitive to rate chasing.
Exactly. Reinforces that core deposit advantage. They aren't having to pay up quite as much as some others might.
Okay, let's switch gears to the other side of the income statement. Non-interest income. The fee story. That looked like another bright spot. Adjusted fees up 6% sequentially.
Yeah, this was impressive. You really see the client relationships paying off here. Records in a couple of areas. Capital markets income, if you strip out the CVA noise, was up a massive 22% just from Q2.
22% quarter over quarter. What was driving that?
A real pickup in M&A advisory work, they said, plus commercial swaps activity and debt underwriting. Seeing M&A hit records is a good sign, suggests their corporate clients are active doing deals, and that's high-margin stuff for the bank.
And it wasn't just capital markets, right?
No, wealth management also delivered its third record quarter in a row. So the fee engines are really humming. That's why they bumped up the full-year fee growth guidance, too, now expecting 4% to 5%.
So growing fee income nicely. And what about cost? Are they keeping expenses in check? That's key for operating leverage.
Very much so. They expect full-year adjusted non-interest expenses to be up only about 2%. Just 2%, which means, yes, they're generating positive operating leverage. Even with the investments we'll talk about, they're keeping a tight lid on costs. Efficiency is clearly a focus.
Okay, Good discipline. Now, let's dig into the loan book. This is that first pillar, the defense now. Average loans were up 1%, which sounds okay, but the full year guidance is basically stable, flat versus last year. That feels counterintuitive, like something's hidden there.
It totally masks what's going on under the surface. You're right. It's deliberate. Year to date, they've actively exited about $900 million in loans they targeted. And they expect another $300 million out by year end. So that's what, $1.2 billion they've intentionally shed?
$1 billion plus.
Right.
Why actively shrink the loan book like that when growth is usually the goal? What were they targeting?
It's all about risk management. They focused on cutting exposure to higher risk leverage lending, specifically mentioning enterprise value lending. That stuff can be more cyclical, tied to, maybe frothy valuations. So they're pruning the portfolio, sticking to stricter credit boxes. Defense first.
Okay, so if they're shedding risk, we should see improvements in overall credit quality metrics.
And we did. Criticized loans, the ones they're watching closely, dropped significantly, down almost $1 billion, or 20%. And interestingly, they noted this was the first quarter in a while where they had substantially more loan upgrades than downgrades. A positive shift.
Didn't net charge-offs go up?
Yeah.
NCOs, the loans they actually wrote off, rose to 55 basis points annualized. How does that fit with improving quality?
Yeah, good catch. Management addressed that directly. They said the rise in NCOs was mainly due to resolving specific problem loans they'd already identified and reserved for. Essentially, finishing the workout process for certain office CRE and transportation exposures. So, taking the pain now, cleaning up known issues proactively.
Got it. So planned resolutions, not new problems emerging broadly. It's part of the cleanup strategy.
Exactly. And they are pretty explicit. Once they work through that remaining $300 million this year, they feel they'll be ready to go and grow in 2026. It really frames 2025 as the year of de-risking, setting the stage for next year's growth.
Makes sense. Let's quickly circle back to deposits before we hit the second pillar. That top quartile growth and low cost, how are they pulling that off?
It sounds like classic community banking strengths, amplified. Long-term presence in smaller towns, secondary markets where maybe the giant banks aren't fighting as hard for core deposits. They mentioned combining service, local branches, and technology, building loyalty.
And it works.
Apparently so. They said 2/3 of their deposits are core consumer non-interest-bearing accounts. That's the gold standard. Checking accounts, basically. Very stable, very low cost.
Okay. And interesting you mentioned loyalty and internal strength.
Yeah.
Because M&A is buzzing in the regional space, right? Competitors are consolidating. But this bank seems determined to go it alone.
Yeah, they were quite clear, focused on their internal plan, internal execution. They explicitly called M&A disruptive right now. They're making a deliberate bet on optimizing what they have and investing in technology rather than buying scale immediately.
Which brings us perfectly to that second pillar, offense later, the technology catalyst. This sounds like a really big long-term play.
It absolutely is. This is a major infrastructure overhaul they're planning.
Tell us more. Core system replacements in banking are notoriously complex, expensive, risky.
They are, no doubt. But the potential upside is huge if they get it right, and they're phasing it. Step one is upgrading the commercial loan system to a cloud platform, planned for the first half of 2026.
Okay, commercial loans first, then what?
Then the really big one, piloting a new cloud-based deposit system in late 2026. The target is full conversion by 2027.
Migrating the core deposit system,
Yeah.
That's like replacing the bank's entire engine while it's running.
Pretty much. Most regionals are running on core systems that are decades old, really cumbersome. Moving to a modern cloud-native platform, it's a game changer. Think better automation, lower compliance costs down the line, much faster innovation for new products. They're aiming to be one of the first regionals truly on a modern core.
That could create a real competitive advantage if they pull it off, separating them from peers stuck on legacy tech.
That's the bet. A multi-year operational advantage. And they seem to have the capital to fund it. Their CET1 ratio is strong at 10.8%. Gives them room for buybacks, dividends, and handling these big investments.
All right, a lot to digest there. Strong quarter, defensive cleanup, and a big offensive tech bet. Now, we have to give our usual reminder here. We're talk tickers. We analyze the earnings calls. We synthesize the info. This next bit involves some speculation based on that info. It is absolutely not investment advice. Please do your own research.
Okay, disclaimer done. So, the outrageous but plausible pitch. Here's the thinking. The market seems fixated on the flat loan growth in 2025. It might be pricing this bank as if that's just stagnation. It seems to be ignoring that the loan stability is strategic, a deliberate cleanup, And it might also be underappreciating the massive long-term impact of that tech pivot.
So the market's being short-sighted, seeing the cleanup as weakness, not preparation, and maybe not fully pricing in the 2027 tech advantage.
That's the thesis. Near-term caution is masking long-term potential. The portfolio shaping gets rid of drag now, sets them up for cleaner growth in 2026, just as those cloud benefits should really start kicking in and potentially driving significant efficiency gains.
Okay, so what's the trade idea itself?
The idea would be consider a long position now. You're not playing for next quarter. You're targeting that 2027 inflection point when the core migration is done and the cost savings are real. And maybe you hedge that, perhaps by shorting a peer regional bank, one that hasn't announced a similar tech overhaul and maybe still has chunkier exposure to those riskier loan types like legacy CRE office or leverage loans.
A pairs trade. Betting on the tech and strategic focus, creating a widening performance gap over the next few years. Long the modernizer, short the legacy player.
Essentially, yes. Betting on technology and execution, driving separation in the regional pack. A long-term view.
Interesting. Okay, let's wrap this deep dive up. The core story seems pretty clear. Strong Q3 results financially, a well-defended net interest margin thanks to that deposit base, a very proactive credit cleanup setting the stage for 2026, and underpinning it all, this major strategic commitment to modernizing their core technology by 2027.
Yeah, management is really planting their flag on internal execution and tech advantage rather than chasing M&A like some peers, which leaves you, the listener, with a pretty fundamental question to think about. Which path wins over the next, say, 5 years? Is it this internal focus optimizing, investing in tech for long-term efficiency and growth starting maybe 2026, 2027? Or is it the path of external growth through acquisition for more immediate scale, especially as that gap between the tech leaders and laggards potentially widens? Something to chew on.